Welcome back to Chapter 7. In this video, we'll cover the 3 depreciation methods that we will be using in this chapter. The first one, if you recall, is the straight line method. We expect an equal amount of depreciation expense every single year. Now in this method, we can calculate the straight line rate, which if you recall is 1 divided by the useful life. It should give us some percent of the total value of the asset that declines each year in depreciation expense. The easiest way, however, to account for the annual depreciation expense in dollar terms is to take the total cost of the asset. Remember, total costs might include freight and installation and some other things, minus the residual value, all divided by the useful life. So, let's try it. Read the information for Morgan Company. Now we're going to use the straight line method of depreciation here. What was the total cost of the machine? Right, $50,000. What's the residual value? The residual value, or the salvage value, is $5,000. What's the useful life? Right, the 5 years. Now, remember that straight line rate? Can we calculate the straight line rate from the information we have? Well, yes, we can. Remember, straight line rate is just 1 divided by the number of years of useful life. So in this case, it would be 1 divided by 5, which means this asset, this machine that Morgan acquired, will be depreciating at an annual rate of 20%. Now, can you compute the annual amount of depreciation expense? Well, let's use the formula we saw on the previous slide. The straight line depreciation expense for every year would be the total cost minus residual value divided by the total useful life. What's the total cost? $50,000 minus residual value of $5,000 divided by 5 years, whoops, there we go, of useful life. So that would mean Morgan should expect $9,000 a year of depreciation expense. Now, could we have gotten this answer by using the straight line rate? Yes, we could have. We could have taken the $50,000 minus the $5,000 of residual value, and that would be $45,000 times 20% a year. 20% of $45,000 is $9,000 a year. Now, for purposes of understanding how the different methods work, let's prepare a depreciation schedule. We know now that Morgan's depreciation expense for this machine is $9,000 every year. Remember, for the straight line method, it's the same amount every year. So the amount for 2011 would be $9,000. It would be that amount for every single year of the asset's life. Remember, it's a 5-year usable life. So the end of 2011 would be the end of the first year, because we bought it in January 1st, 2011. End of 2012 is the second year. End of 2013 is the third year. End of 2014 is the fourth year. End of 2015 would be the end of the useful life for this machine. Now we know that on the date of purchase at the beginning of 2011, the value of the machine, the total cost, was $50,000. And if you remember, total cost equals the book value on the date of purchase, okay? So the date we buy it, the book value is going to be the exact same amount as total cost. Now, over time, we're going to see that book value decline, though, because we will be capitalizing it. We will be subtracting some depreciation expense. So, in 2011, we have depreciation expense of $9,000, and how much total accumulated depreciation would we have? Well, 1 year's worth. $9,000. So the book value would now be $50,000 minus $9,000, or $41,000. In 2002, we have $9,000 of appreciation expense. How much total accumulation depreciation would we now have? accumulated depreciation? Well, we'd have the 9,000 from 2011 plus another 9,000. Let's actually write this a little smaller. We'd have 9,000 from 2011 plus another 9,000 from 2012, which would get us $18,000 of accumulated depreciation in 2012. If we say $50,000 minus $18,000, what would be the total book value at the end of 2012? $32,000. So let's look at this all completed. We started with a book value of $50,000, but every year we subtract $9,000 of depreciation expense. $41,000 minus $9,000 gets us $32,000. $32,000 minus $9,000 gets us $23,000. Minus $9,000 gets us $14,000. Minus $9,000 gets us $5,000. What is the total book value of this asset at the end of 5 years? Right, $5,000. What was the residual value? $5,000. So that's good. We should have, at the end of the asset's life, the remaining book value should equal the residual value. The total depreciation, accumulated depreciation, should be the sum of all the years of depreciation expense. So notice, the total accumulated depreciation at the end of 2015 equals the sum of all the years of depreciation expense. If we take the original book value minus the total depreciation expense, which would also be the same as the final year's worth of accumulated depreciation, we should get the residual value, or the remaining book value. Now let's do one last thing. Let's prepare the journal entry that we would need to use to record depreciation expense for the year 2011. For using the straight line method, we would get to the end of the year on December 31st, and we would say how much of depreciation expense happened that year? Right, $9,000. So what would be our entry? Well, depreciation expense is an expense account, so we would make a debit entry to depreciation expense for $9,000 and a credit entry to which account? Do you remember? Right, accumulated depreciation, which is the contra asset account, so there would be a $9,000 credit to that account, showing us the depreciation expense for 2011. Now let's move on to the next depreciation method, the declining balance method. If you recall, this is an accelerated depreciation method, which means that it causes the depreciation expense in the early years to be faster or higher amounts so that the asset declines in value faster. You should expect more depreciation expense in the early years and a lower amount in the later years if you compare declining balance method to the straight line method. Now, that multiple of the straight line rate is usually, or often rather, it is 2, which is why we often call the declining balance rate the double declining balance method, because we are often using 2. And how do we then solve for this? Well, we figure out what the declining balance rate will be, which means we take that old straight line rate, the 1 divided by the number of years of useful life, and we multiply it by whatever the multiple is. It'll often be 2. Once we do that, we can determine the depreciation expense by taking that declining balance rate, which might be a double declining balance rate, and we multiply it by that year's book value. Now remember, the original book value for any operating asset will be its total cost. But then over the years, as the asset depreciates, we expect the book value to continue to decline by the amount of accumulated depreciation. So we're going to go back to the exact same company with the exact same machine, but now we're going to use the double declining balance method. So what would be the double declining balance rate of depreciation? Well, remember, the rate is always going to be the straight line rate times the multiple. If I said it's double declining balance, what is that multiple? That multiple is going to be 2. So 2 times the straight line rate. What was Morgan's straight line rate? Well, it was 1 divided by 5, right? Which is the same as saying 20%. So double that would be 40%. That means every year we want this asset to decline in value by 40% of its starting book value for the year. So let's just prepare the depreciation schedule. Remember, in this method, we do not have the exact same amount of depreciation expense every year. It will be different every year. So we will have to build a depreciation schedule a little bit more closely. So for 2011, what would be the depreciation expense? Well, if you remember, depreciation expense equals the double declining balance rate times exactly the book value. So what's the book value at the beginning of 2011? Well, it's the total cost, remember? On the purchase date, total book value is the total cost. So it'll be the the total book value times the double declining balance rate, which was 40%. What's 40% of $50,000? It'd be $20,000. $20,000 of depreciation expense for the first year. Now compare that to the straight line method. It was only $9,000. So obviously the double declining balance method causes depreciation to happen a lot faster. At the end of 2011, you would only had 1 year of depreciation expense, so your accumulated depreciation is simply the exact same amount, which means the book value will be original book value minus the accumulated depreciation, so the ending 2011 book value would be $30,000. In the straight line method, at the end of 2011, this machine still had a value of $41,000 on the books. So it does create quite a big difference. It causes a much lower book value and a much higher annual depreciation expense in the early years. Now, how do we solve for the 2012 depreciation expense? Right. We take the most recent book value. If we ended 2011 with $30,000 book value, then we started 2012 with $30,000 in book value, and we multiply that by our double declining balance rate, which is 40%. What is 40% of $30,000? It's going to be $12,000. So we have $12,000 of depreciation expense for 2012. What does that make our total accumulated depreciation at the end of 2012? Right, $32,000. So now we need to decrease last year's ending book value by the additional amount of depreciation, which is $12,000. So 30 minus 12,000 would get us 18,000. The other way to look at that is take our original book value minus total accumulated depreciation. 50,000 minus 32,000 also gets us $18,000. So how do we solve for 2013 depreciation expense? Right, I'm going to take my most recent book value, because that's what I'll start 2013 with. I take $18,000 and I multiply that by my double declining balance rate of 40%. 40% of $18,000 is $7,200. Now notice, we're finally having a depreciation expense amount that is less than what the straight line method would have given us. Remember, straight line method gave us a single amount, the same amount per year. Double declining balance, I have a different amount of depreciation expense per year. So $7,200, I have an additional amount now to add to accumulated depreciation, so that means there's now total accumulated depreciation of $39,200. $50,000 minus $39,200 gets me $10,800. Now let's see how we do 2014 and 2015. 2014, I take my ending book value from the previous year, I multiply it by my double declining balance rate, and I get $4,320. I add that amount to, actually I add it to the $39,200, and that's how I get $43,520. And that means $50,000 minus $43,520 gets me $6,480 in remaining book value at the end of 2014. Now here's where we have to be tricky. If you recall, we still have to pay attention no matter which depreciation method we use. We have to care about what the company believes the residual value to be. We also have to make sure that ultimately the total depreciation expense adds up to the exact same amount that it would have in our straight line method. And that total depreciation expense amount, which would also be the same as the ending accumulated depreciation, it's got to equal whatever the difference between starting book value and the residual value would be. Now, if you were just moving along and not paying attention and doing your double declining balance method, for 2015, you would have grabbed the ending 2014 book value of $6,480. You would have multiplied it by 40%, and you would have gotten $2,592. And if you subtract $2,592 from $6,480, you get something less than $5,000, don't you? But you know that this asset, this machine, is supposed to have a residual value of $5,000, so we cannot have a book value at the end of 2015 that is less than $5,000, right? So this is what you have to do when you are doing the double declining balance method and you get to the final year. You need to see if by using the normal formula in the method, if you'll actually be creating too much depreciation expense and thereby lowering the book value below residual value. If that's going to happen, here's what you have to do. Try to figure out at $6,480, how many more dollars do I have to go until I hit residual value of $5,000? Well, you would just take the remaining book value of $6,480 and you subtract the residual value that you expect, and you get $1,480. That, the $1,480, is your actual depreciation expense for 2015. If you add $1,480 to $43,520, you get total accumulated depreciation at the end of 2015, which is the end of the useful life, of $45,000. It also gives you a remaining book value of $5,000, which is exactly what you expected. Now, if you add each year's depreciation expense, $20,000 plus $12,000 plus $7,200, and you go down the list and you add the $1,480 for 2015, you should come up with exactly $45,000 of total depreciation expense. Remember, all three methods of depreciation that we are using should result in the exact same total depreciation expense and a final book value at the end of the useful life of the residual value that we were expecting. Now, just to make sure we're remembering how the journal entries work, if you were going to record the depreciation expense in 2011 using the double declining balance method, how would you have made your entry? Well, we get to the end of 2011 and we say, oh, I got to make my depreciation adjustment entry, and we know we need to make a debit to depreciation expense, and what would that amount have been? Well, let's go back to our depreciation schedule. What was the total depreciation expense for 2011? In this method, it was $20,000. So let's grab $20,000. That's the debit we make to depreciation expense. What's the credit entry? Right, we always, when we're doing our depreciation adjustments, it's always a debit to depreciation expense and a credit to accumulated depreciation, which is the contra asset account on the balance sheet. All right, now stick with me. We're going to cover that third method, and that's units of production. Remember, it's based on usage, not on a useful life, which means we're going to have to come up with not a declining balance rate, but a depreciation cost per unit of production. And we come up with that by taking the total cost of the asset, the original cost, the original book value, minus residual value, and we divide by the expected asset usage, the total number of units we expect to get from the asset. We then take that depreciation cost per unit, which is going to be this number, some dollar per page, dollar per machine hour, something like that, and we multiply it for each year by however much the asset was actually used that year. So, on January 1st, 2011, same machine, same cost, but what do you see that's different? Right. We also expect, instead of just knowing that we think it has a 5-year useful life with a residual value of $5,000, we now also believe that the machine should run for about $30,000. 30,000 machine hours. So, this is how they expect to actually use the machine in these years. So as we get through each year, you should say that this is how many hours the machine actually ran for. Notice they seem to use it the most in 2012. So first we have to figure out in this method, what is the depreciation cost per machine hour? Well, remember, we said that the way to do that is take the total depreciable cost, which is what your book calls it. Depreciable cost just means the $50,000 minus the residual value of $5,000, and we divide it by the estimated usage. What was the estimated usage? Not the actual usage per year, but the estimated number of hours the machine should run. It's 30,000 hours. So we do the same thing we would have done in the old straight line method. We take $50,000, the total book value at the beginning, which is equal to the total cost, minus the residual value, divided by 30,000 machine hours, and we come up with $1.50 per machine hour. We expect that this machine depreciates at the rate of $1.50 for every hour the machine runs. So can we prepare a depreciation schedule on that? Yes, we absolutely can. And the way to do that when we're dealing with units of production method is we actually add a column for the cost per machine hour and the actual usage each year in hours, because that's going to make it real simple to figure out the total depreciation expense each year. Now, what did we say the depreciation cost per unit is? Well, in this case, it's the cost per machine hour, and we said it was $1.50. Now, does that change it throughout the life of the machine? No, it does not. So we expect $1.50 of depreciation expense per machine hour. Now, what is the actual usage in hours for 2011? It's 3,000 hours, which we got from our chart up here, which we got in the problem. So what is the depreciation expense for 2011? Right, it's simple. It's just going to be the $1.50 times 3,000 hours. And what does that equal? $4,500. So what is the total accumulated depreciation for 2011? Well, we only have 1 year of depreciation so far, so it's just going to be $4,500. What is 50,000 minus $4,500? Right, it's going to be $45,500. Now, if you notice in this method, it just so happens that based on machine usage, the depreciation in 2011 is smaller than it would have been in the straight line method or in the double declining balance method. Now, if they had used more hours in 2011, then it would have been more. So how do we do it for 2012? Well, it's going to be $1.50 times 9,000 hours. And what's $1.50 times 9,000 hours? Yeah, that's going to be 13,500. So what's the total accumulated depreciation? Well, it's 13,500 plus 4,500, which is going to give us $18,000 of accumulated depreciation. $50,000 minus $18,000 gets us $32,000. The other way to figure out book value at the end of 2012 would be to take $45,500 minus the $18,000 of the 2012 depreciation expense, minus the $13,500 of the 2012 depreciation expense. Make sure you're looking at the right column. So $45,500 minus $13,500 would get us $32,000. Now let's actually look at this all the way completed. 2013, $1.50 times 7,500 hours gets us 11,250. That means if we add up all the 3 years now of depreciation expense we should have accumulated depreciation of 29,250. 50,000 minus 29,250 gets us 20,750. 2014, we do the same thing. It's $1.50 times 4,500 hours, which we grabbed from our chart up here. So it's $6,750. We add that amount to last year's accumulated depreciation, and we get $36,000. 50,000 minus $36,000 is $14,000. And in the last year, if we multiply $1.50 times 6,000 hours, we get $9,000. 14,000 minus 9,000 gets us a $5,000 residual value, which is the residual value we got in all three methods. If you notice, the accumulated depreciation at the end of the final year of the useful life of the machine is also going to be the same amount in all three methods, or $45,000. And if we were going to make the entry for the depreciation expense at the end of 2011 using the units of production method, well, let's go back. What was the depreciation expense from 2011? $4,500. So on December 31st, 2011, wow, that would have been a really late year. 2011, what would be the entry for depreciation expense? Right. It would be depreciation expense of $4,500 and a credit entry to accumulated depreciation of $4,500. And that concludes this video.